Best imagine waking up one morning, checking your portfolio, and seeing the value of your investments drop by 30%, 40%, or even 50% overnight. The headlines scream stock market crash, and panic spreads like wildfire. Many of us remember 2008 when millions of people lost their life savings, their homes, and their financial security. But here's the shocking truth: the bubble we're seeing today could be even bigger than 2008. You've heard warnings about overvalued stocks, excessive speculation, and rising debt, but very few people truly understand the scale of what's happening. Right now, tech companies are trading at sky-high valuations, some with no real profits to justify them. Retail investors are pouring money into speculative stocks, cryptocurrencies, and meme stocks, hoping for another quick win. Meanwhile, institutions are leveraging debt at levels that make the 2008 crisis look tame in comparison. This isn't fear-mongering. It's the reality of the numbers we see every day in financial statements, interest rates, investment, and market behavior. But here's the thing: you don't have to be a victim. Understanding the warning signs of a bubble, knowing how to protect your money, investment, and making smart investment decisions can save you from financial ruin. In this speech, we'll break down the most critical insights, expose the hidden risks, and equip you with strategies to not just survive, but potentially thrive, even if the bubble bursts. By the end of this talk, you'll understand why the market is more dangerous than ever, what history teaches us about bubbles, the psychological traps that investors fall into, and practical ways to shield your wealth before it's too late. Your attention today could make the difference between losing everything and preserving your financial freedom. So let's dive in. The current stock market is showing signs of extreme overvaluation, and understanding this is crucial for anyone who wants to protect their wealth. Overvaluation occurs when stock prices rise far beyond what the underlying company fundamentals can justify. In simpler terms, people are paying far more for a share than the company is actually worth based on its earnings, assets, and growth potential. When valuations reach extreme levels, investment. It's not just a warning, it's a red flag signaling that the market is entering dangerous territory, much like what we saw in the housing market in 2008. Back then, people were buying homes at prices that no reasonable income or rental yield could support. Today, instead of homes, it's stocks, especially in sectors like technology, biotech, and other high growth areas that are trading at historically unprecedented multiples. Investors have been conditioned over the last decade to expect continuous growth. Low interest rates, government stimulus programs, and a decade-long bull market created a belief that prices would never fall significantly. Tech stocks, in particular, have benefited from this mindset. Companies with little to no profit or with earnings that barely justify their operations have seen their stock prices soar purely based on expectations of future growth. Take, for example, companies in the AI or renewable energy sectors. Investors are betting on what these companies might do 5 or 10 years from now, ignoring what they are actually producing today. This speculative behavior drives prices higher, but it also creates a fragile market structure. When stock prices detach from reality, even a minor disappointment in earnings reports, product releases, or market sentiment can trigger sharp declines in investment because the inflated expectations are impossible to sustain indefinitely. It's not only retail investors fueling this overvaluation. Institutional investors, hedge funds, and private equity firms are also deeply invested in these high-priced stocks, creating a feedback loop where prices keep rising simply because everyone is buying in. This herd mentality amplifies the bubble effect. When everyone rushes toward the same high-flying assets, the market can appear to be thriving, masking the underlying weakness. Fundamentals like revenue growth, profit margins, and cash flow investment often take a backseat to hype, projections, and the fear of missing out. Investors forget that a company stock is not just a number on a screen. It represents a claim on the actual value the business creates. When that disconnect grows too large, the risk of a sudden correction skyrockets. Another critical factor contributing to overvaluation is the effect of low interest rates on investor behavior. Investment. Cheap borrowing costs make it easier for investors to take on debt to buy more assets, which pushes prices higher. When interest rates are near zero, then investors are willing to pay more for stocks because the opportunity cost of holding cash or bonds is extremely low. This artificially inflates valuations, and while it can make portfolios appear healthy in the short term, it builds systemic risk in the long term. As interest rates rise or liquidity conditions tighten, these overvalued stocks can experience swift declines. And history repeatedly demonstrates that markets cannot stay detached from fundamentals forever. Extreme valuations often precede significant market corrections, and the higher the valuation, the steeper the potential drop when reality catches up. It's also important to recognize that extreme valuations aren't just theoretical, they have measurable consequences. Analysts use metrics like price to earnings ratios, price to sales ratios, and market capitalization relative to GDP to gauge how inflated the market is. Currently, investment. Many tech companies are trading at peak E ratios that are 2 to 3 times higher than their historical averages, which should raise serious concern. When a company's market value vastly exceeds its earnings, it's a clear sign that the market is pricing in unrealistic levels of future growth. This is not a sustainable trajectory. Just like a balloon, overinflated markets eventually have to deflate, and when they do, the fallout can be swift and severe. Finally, understanding overvaluation is not just about worrying, it's about strategy. Knowing that the market is priced above reasonable levels allows investors to make informed decisions, protect their capital, and even take advantage of opportunities when others panic. Avoiding speculative stocks, investment, focusing on companies with strong fundamentals, and being patient are key strategies to navigate overvalued markets. By recognizing the signs of extreme valuation, investors can position themselves to withstand downturns. Good investment, rather than being caught off guard when the bubble inevitably corrects. Overvaluation is not just a number, it's a signal that demands attention, discipline, and thoughtful action. One of the most critical dangers in today's stock market is the enormous level of leverage and debt being used by both individuals and institutions. Leverage, simply put, is the practice of borrowing money to increase the potential return on an investment. While leverage can amplify gains, it can also magnify losses, turning a small downturn into a financial catastrophe. In the years leading up to 2008, excessive borrowing was one of the main causes of the housing crisis. Mortgages were extended to people who couldn't realistically repay them. And financial institutions used complex instruments to multiply exposure. When the market turned, the effects cascaded through the entire financial system, causing trillions of dollars in losses. Today, investment leverage is being used in the stock market at levels that are just as concerning, if not more so. Margin accounts, options trading, leveraged ETFs, investment, and corporate debt all contribute to an environment where a market correction could trigger a chain reaction of selling and panic. Retail investors have increasingly turned to margin trading, often without fully understanding the risks. By borrowing money to buy more stock than they could otherwise afford, investors are betting on the market continuing its upward trajectory. And this approach can create extraordinary short-term profits, but it also exposes investors to margin calls, which force them to sell their holdings if prices fall too far. Investment, this automatic selling adds fuel to the fire during downturns, accelerating price declines. For example, if a heavily leveraged investor owns 100,000 worth of stock, but only put in 52,000 of their own money, a 20% drop in the market could wipe out their entire investment. Multiply this scenario across millions of investors, and it's easy to see how leverage can turn a minor correction into a full-blown market crisis. It's not just retail investors that are contributing to this dangerous environment. Corporations themselves have taken on record levels of debt over the past decade, with interest rates historically low for so long. And companies have borrowed heavily to fund stock buybacks, acquisitions, and other growth initiatives. While this strategy can temporarily boost stock prices, it also creates a fragile financial structure. Investment. If revenue declines or interest rates rise, these companies may struggle to service their debt, potentially leading to bankruptcies or forced asset sales. In the event of a broader market correction, these vulnerabilities can ripple through the economy, affecting everything from employment to investor portfolios. Hedge funds and institutional investors also rely heavily on leverage to enhance returns. By borrowing billions of dollars to invest in highly speculative assets, these institutions can generate massive profits in a rising market. However, the same leverage makes them extremely vulnerable to sudden market swings. A small decline in asset prices can trigger margin calls, forced liquidation, and panic selling, which can destabilize the entire market. The interconnectedness of today's financial system means that losses in one sector can quickly spread to others, magnifying the impact of any correction. Then it's important to understand that leverage doesn't just increase risk, it transforms it into a systemic threat. When too much debt exists at every level, individual investors, corporations, and institutions. The market becomes more sensitive to external shocks, geopolitical events, changes in monetary policy, or disappointing corporate earnings can trigger reactions far greater than the initial event itself. This is why analysts watch margin debt, corporate leverage ratios, and other indicators so closely that they provide insight into how fragile the market has become. High levels of leverage can accelerate a correction and increase its severity. Investment, turning what might have been a normal market adjustment into a significant financial crisis. Preparing for this environment requires a disciplined approach. Investors need to be aware of how much debt they are carrying, and both personally and within the assets they own. Reducing exposure to highly leveraged instruments, avoiding excessive margin, and focusing on investments with strong fundamentals can provide a buffer against volatility. In addition, keeping a portion of your portfolio in liquid assets, such as cash or short-term bonds, ensures you have flexibility during turbulent times. The key is to recognize that leverage is a double-edged sword, that it can generate outsized gains, but it can also wipe out wealth rapidly when the market turns. Leverage is one of the silent dangers of the current stock market bubble. While it may go unnoticed during periods of growth and optimism, it becomes painfully clear during downturns. The lessons of 2008 are still relevant today. Excessive debt magnifies risk. And when the market inevitably faces corrections, those who are over-leveraged suffer the most. Understanding the role of leverage, monitoring exposure, and maintaining a conservative approach can mean the difference between surviving a market crash and being caught in a financial disaster. By taking leverage seriously, investors can protect themselves and position their portfolios to endure volatility rather than fall victim to it. One of the most underestimated aspects of a stock market bubble is the role of investor psychology. While numbers, valuations, and leverage are critical, it's human behavior that often drives markets far beyond rational levels. Greed, fear, and herd mentality are powerful forces that can create extremes in market prices. Bubbles are rarely purely a function of economic fundamentals. They are amplified by collective human behavior that pushes prices to unsustainable highs. Understanding this psychological component is crucial for anyone who wants to protect their money during a potential market collapse. The phenomenon of FOMO, or the fear of missing out, plays a significant role in inflating stock bubbles. As stock prices rise rapidly, investors become desperate not to miss the next big gain. This leads to irrational buying decisions, where the fear of being left behind outweighs careful analysis. People buy stocks not because they believe in the underlying business, but because everyone else is buying and they don't want to be excluded from the perceived profit. Social media, financial news outlets, and online forums amplify this effect, constantly reminding investors of high returns and wants in a lifetime opportunities. As more people chase these assets, prices rise further, creating a feedback loop that disconnects the market from reality. Herd mentality is another psychological trap that fuels bubbles. When investors see others making money, they often feel compelled to follow the crowd, assuming that the collective knowledge of the market is superior to their own judgment. This can lead to irrational exuberance, where fear and greed override logic. The result is a market where valuations soar far beyond sustainable levels, and caution is ignored. History repeatedly demonstrates that when herd behavior dominates, as corrections are not gradual, they are abrupt and painful. The 2008 housing crisis, the dot-com bubble of the early 2000s, and even speculative surges in cryptocurrencies all share this pattern. Collective behavior pushes asset prices to extremes, only to reverse violently when reality sets in. Psychological biases such as overconfidence and confirmation bias also exacerbate bubbles. Overconfidence leads investors to believe they can time the market perfectly or pick winning stocks with certainty, ignoring the inherent risks of speculation. Confirmation bias causes them to seek out information that supports their optimistic outlook while dismissing warning signs. Together, these biases create an environment where irrational exuberance flourishes, and critical thinking takes a backseat. Investors convince themselves that this time is different, ignoring the lessons of history and the basic principles of market behavior. And fear is just as powerful as greed in driving market psychology. When the bubble begins to show cracks, such as disappointing earnings reports, rising interest rates, or geopolitical tensions, fear spreads quickly. Panic selling often follows, leading to sharp declines in asset prices. Because many investors are over-leveraged or heavily concentrated in speculative assets, even minor corrections can cascade into widespread losses. Man, this combination of fear and leverage is what transforms a market correction into a full-blown crash. Those who fail to recognize these psychological triggers are often the most exposed and suffer the heaviest losses. The good news is that understanding investor psychology can give you a significant edge. By recognizing the signs of FOMO, herd mentality, and cognitive biases, you can make rational decisions rather than emotional ones. Discipline becomes your most valuable tool. Sticking to a long-term plan, avoiding speculative hype, and focusing on fundamentally sound investments can protect your portfolio when others are caught up in panic or greed. Investors who remain calm during periods of irrational exuberance often find opportunities when the market corrects, acquiring valuable assets at discounted prices while others rush to sell. Education and awareness are key to navigating a market driven by psychological forces. Monitoring social sentiment, being mindful of overhyped sectors, and questioning the rationale behind your own investment decisions can prevent you from falling into common traps. Remember, bubbles are not just a matter of economics. They are a reflection of collective human behavior. When emotions dominate, markets can move far beyond reason, creating both extraordinary gains and devastating losses. Ultimately, an understanding investor psychology is about preparing for volatility rather than predicting it. No one can accurately forecast the exact timing of a bubble burst, but by being aware of how fear and greed shape market behavior, you can protect your wealth and make strategic decisions. Recognizing that irrationality drives prices to extremes allows you to separate your actions from the crowd, reduce unnecessary risk, and even capitalize on opportunities during market corrections. In a bubble, investment, discipline, and emotional intelligence are just as valuable as financial knowledge, and those who master them are far more likely to survive and thrive when the market inevitably turns. Protecting your money before a stock market bubble bursts is not just smart, it's essential. The current market environment is extremely fragile, with overvalued stocks, excessive leverage, and heightened investor psychology creating a perfect storm for a potential collapse. While no one can predict the exact timing or trigger of a market correction, there are clear strategies that investors can implement to safeguard their wealth and even position themselves for long-term gains. The key lies in preparation, discipline, and a focus on fundamentals rather than hype. One of the first steps in protecting your money is diversification. Diversification means spreading your investments across multiple asset classes, industries, and geographic regions so that no single event can devastate your entire portfolio. For example, instead of putting all your money into tech stocks that have skyrocketed in value, you could allocate a portion to dividend-paying companies, bonds, and even commodities like gold. Diversification doesn't eliminate risk entirely, but it reduces the likelihood of catastrophic losses. When a bubble bursts, highly concentrated portfolios in overvalued sectors often experience the steepest declines, while diversified portfolios have buffers to absorb volatility. Liquidity is another crucial factor. Keeping a portion of your portfolio in cash or cash equivalents ensures you have flexibility during turbulent periods. When markets decline sharply, liquid assets allow you to cover personal expenses, take advantage of buying opportunities, or avoid being forced to sell investments at a loss. During the 2008 crisis, many investors who maintained liquidity were able to purchase high-quality assets at deep discounts, while those fully invested in over-leveraged positions suffered massive losses. Planning for liquidity isn't just about protection. It's also about positioning yourself to act when opportunities arise in a downturn. Another effective strategy is focusing on investments with strong fundamentals. Companies with healthy balance sheets, consistent earnings, and sustainable business models are far more likely to survive market corrections than highly speculative ventures. Dividend-paying companies, for instance, provide a regular income even during market downturns, which can cushion portfolio losses. Avoiding hype-driven assets, over-leveraged companies, and speculative instruments reduces exposure to sudden shocks. Investing in quality doesn't guarantee immunity from market swings, but it significantly improves the odds of weathering a crash with minimal damage. Hedging strategies are also worth considering. These involve using financial instruments such as options or inverse ETFs to protect against downside risk. While these strategies can be complex, they serve as a form of insurance for your portfolio. Hedging doesn't prevent losses entirely, but it can limit them, providing peace of mind in highly volatile markets. Investors who understand and implement hedging strategies are often better equipped to handle rapid declines without panic, avoiding the emotionally driven mistakes that amplify losses. Emotional discipline plays a critical role in protecting your money. Panic selling during a market downturn is one of the most common mistakes investors make. When a bubble bursts, prices can drop precipitously, and fear often overwhelms rational decision making. Those who act impulsively, selling at the bottom, lock in losses rather than waiting for the market to stabilize, developing a long-term perspective investment. Staying calm under pressure and sticking to a predetermined investment plan are essential for preserving capital and avoiding unnecessary losses. It's also important to monitor debt and leverage within your personal portfolio. Avoid borrowing excessively to invest, as leverage positions amplify both gains and losses. Reducing debt exposure, investment, maintaining manageable margin balances, and avoiding speculative loans or high-risk strategies can protect you from forced liquidations when markets turn. In essence, controlling leverage is a form of self-insurance that prevents minor downturns from becoming financial disasters. Lastly, preparation includes education and awareness. Keeping informed about market trends meant understanding valuations and recognizing early warning signs of a bubble allow you to make proactive decisions rather than reactive ones. Being aware of broader economic conditions, interest rate trends, and corporate financial health can help you anticipate potential risks and adjust your portfolio accordingly. Preparation isn't about predicting the exact day a bubble will burst. It's about being ready to respond thoughtfully and strategically when it does. Ultimately, protecting your money before a market collapse requires a combination of diversification, liquidity, fundamental investing, hedging, discipline, leverage control, and education. These steps create a robust framework for weathering volatility and preserving wealth. While bubbles are inevitable, the difference between financial disaster and resilience lies in preparation. Investors who understand the risks, take proactive measures, and maintain discipline are not only more likely to survive a market collapse, they are positioned to take advantage of the opportunities that inevitably arise when fear and panic dominate the market. Protecting your money is not passive. It's a proactive, strategic approach that ensures you remain in control even when the market seems out of control.